Balance sheet provides information about company's overall financial position. In this session, I will cover: what is balance sheet? How balance sheet look for a listed company. Balance sheet is a financial statement that provides information about company's assets, liabilities, and shareholders' equity. Let's get into the details of balance sheet. One side, it reports company's assets. Assets are the things that company owns. Assets are divided into two different categories: non-current assets, current assets. The other side of balance sheet reports liabilities and equity. Liabilities are the things that company owe. In other words, it shows debt and other liabilities company is obligated to repay. Liabilities also are divided into two categories: non-current liabilities, current liabilities. The other important component reported on liability side is shareholders' equity. As per accounting rules of the balance sheet, the company's total assets should always be equal to the total liabilities and equity. I will provide more clarification on this shortly. Let's go one step further and understand types of assets and liabilities. Starting with non-current assets. These are assets that cannot be easily converted into cash within a year. There are several types of assets classified as non-current assets. Starting with fixed assets. Fixed assets are long-lived assets. Typical examples of fixed assets are property, plant, equipment, land, machinery, vehicles, and so on. It also includes intangible assets. Intangible assets do not have a physical nature. It includes intangible assets like patents, copyrights, trademarks, and so on. Along with the fixed assets, non-current assets include other line items as well. It includes companies' long-term investments. This investment could be buying equity shares of other companies, minority stake in other companies, debentures, mutual funds, and so on. The next category of assets is current assets. Current assets are the assets that can be easily converted into cash within a year. Current assets are used to fund company daily expenses. It includes cash, receivable from customers, product inventory, money raised through short-term loans, and so on. I hope you understand the asset side of balance sheet now. It's time to review the liability side. Starting with non-current liabilities. It represents the company's long-term debt listed on the balance sheet. The debt listed under non-current liabilities is not due immediately. However, it represents the debt or liabilities that will become due beyond 12 months in future. Typically, it includes companies' long-term borrowings, deferred tax liabilities, and long-term provisions. The next category of liability is current liabilities. It includes short-term debt or liabilities that is expected to be settled within a year. It includes short-term liabilities like short-term debt obligation, money owed to suppliers, short-term provisions, and so on. The next important line on the balance sheet is shareholders' equity. Typically, it includes equity share capital and other equity. Equity share capital is funds collected by company through IPO process. Other equity includes the retained or accumulated profits on balance sheet over the years. This is also referred as retained earnings or reserve and surplus. It's good idea to summarize the balance sheet now. On one side of balance sheet, you will see assets. Assets are non-current assets and current assets. The other side is liabilities. Liabilities are non-current liabilities and current liabilities. Shareholders' equity is listed under liability side of balance sheet. It includes funds collected by company through IPO process. It also includes retained profits over the years. This means shareholders' equity are the funds belonging to the company shareholders. You might question, why do shareholders' equity is liability for the company? In order to understand this concept well, don't think as shareholder. Change your perspective and think solely from company's perspective. From company's perspective, shareholders' equity are the funds owed to shareholders and do not belong to the company. Hence, this is shown on the liabilities side of the balance sheet. This is an important concept to grasp since many people find it difficult to understand. Let's look at balance sheet equation now. The company's total assets should always be equal to total liabilities and equity. In other words, assets minus liabilities is equal to shareholders' equity. Let's summarize the balance sheet. Assets represents what you own as a company. Liabilities represents what you owe. Assets minus liabilities is shareholders' equity. It represents company's net worth. This is the money belonging to company shareholders. This is also called as book value of the company. Thank you.